So friends, let's start with some industry talk with the eminent women professionals that have joined us here today. Our first discussion of the day is redefining real estate for attracting new age investors.
Quite interesting, Carol Nissa. I'll bring in Sarah, who's done some developments in these tier 2, tier 3 markets, and of course, commercial assets in Bangalore, and of course, award-winning resort too. So, Sarah, what's your view in terms of what are the investors looking at in a commercial real estate when they're doing investments? Because of course, Bani feels that the concept of ownership will change for 15 years, and there, of course, a lot of conversation around the tech disruption that will happen.
Hi, everybody. Good afternoon. So when investors look at commercial real estate, the asset classes could range between a retail, office space, and a hospitality warehousing. And this could be at a greenfield, a brownfield, and a rent-yielding asset. Okay. So let's look at the investment strategies, what goes into an investor's mind. I'm quickly going through some of these investment strategies for commercial real estate, starting from the least risk to the high risk. Okay. The first one is the core investment. So basically what they do is they like to buy out the highest quality of asset, which will have the lowest yield. Okay. But it is very safe. So example, you buy a JW Marriott, the risk is very low because the product is at the best condition and the seller puts in at a very high price. But the yield at the end of the day is low, and that's proportional. And the next one is the Core Plus. So which means you take a B class building and you want to upgrade it to a B plus category. Right. And you're trying to upgrade it into a higher grade, which means like a 55 rupees, and you're increasing it to a 75 rupees. So the investor does see some sort of a, increment. And then there's a value add where you actually take the C class and you try to make it into a B or an A by renovating it. There is risk involved now. And when you look at an opportunistic, investment strategy, it is basically a distressed property where actually they buy small assets where the risk is attached to it. And say Blackstone does this, okay? And they buy small industrial buildings around the peripheries of the cities. And they, what they do is they buy about 10 to 100 of such properties, and then they group them together to create a portfolio and thereby creates value out of it. And then it becomes opportunistic. Then there are distress. That means the financing mix is wrong. They've lost their large tenants, and if the building is actually in trouble, then you buy it at a very low price. So that allows you to upgrade, and the investor makes money eventually. But the best one is the greenfield and the development, where you actually, buy a building and you knock it off and you actually start from fresh, or you pick up a land and you start developing it. So, but what are investors actually looking for? They're basically looking for locations. Obviously, the supply and demand of the locations come into play, and the study of the micro markets, the road expansions or the metros, and all of that come into play. And say, suppose like Mumbai. In Mumbai, if I pick up a building in the center of the city, it is actually good because there is no chance that a competitor is going to come in with a new building next door, and it is not easy to get permits. Okay. And then there's a sector which are resilient. So basically cities that have mixed use industries and old time money that is there. So that's very safe. Investment horizons and investment returns. So basically there are private investors. They look to take total returns for about 3 to 7 years, and then they want their capital, but also along with some mixed income. And then institutional investors, they prefer like evergreen capital, steady yield, all of this. And then the office spaces which have the long-term lease, whereas the retail has the short-term, but then they have higher appreciation because of the short-term lease that they have. But let me tell you, beyond all of this, more than the location, your tenant mix, your financial performance, your valuation, or your lease term or the cash flow, if it is a new age investor, they are looking beyond all of this. He's looking at potentials of the builder and the developer to deliver. The builder's potential to bring out an attractive product and a niche product to the table, and the builder's ability to incorporate sustainability, layers of sustainability and ESG metrics, very important. And a commercial real estate that's definitely going to, yield a higher return of investment. Yeah.
Interesting. Sarah, on the commercial real estate front, as service providers, sometimes we get a lot of flack from the development community that we need to educate the occupiers that annual escalation or a 15% after 3 years doesn't work. It doesn't beat the inflation. What's your suggestion? I mean, because it's more of a like Bani said, from a retail residential REIT perspective, that somebody will bell the cat, will probably make exponential returns. Similarly, in the commercial real estate, it's more of a space wherein it's a me too mentality, right? If everybody is at a 15% after 3 years or a 5% annually, it's very difficult to change that mindset of an occupier because he has options.
Yeah. So I think when I'm just talking from an investor perspective, especially when you have this ESG in place, like if you, you can't go beyond a certain, like you said about that 15% and all of that. But I kind of think it is more about giving, like the social, if the company has a better social governance perspective. Basically, they have to talk about the employees being treated well and the employee systems and the organization culture, because then you retain your employees and you retain so when you choose your tenants, you make sure that it's not just the infrastructure, but it is also about a company that is actually going to stay for long. So that also matters, because if they are not able to hold on to their people, then I think the company is going to collapse. Yeah.
Fair point.
And also about the governance, I just want to make a point, because there are commercial real estates projects in Bangalore that I know of, where they've actually gone beyond measures to actually reduce the traffic around that community and go over and develop a flyover, which then makes it easy for the environment around this particular project, and thereby easing the whole system. So it may be, from pockets of what they could contribute, but it does help the community at large.
Thank you.
We have some audience questions as well, and Gautam, I'll bring it to you, and you can decide what speaker should take that question. One of the questions that have been asked is about the JVs and consolidation. So how are listed developers looking at inorganic growth through JVs and consolidation? Gautam, up to you, who should take that question?
Sarah, you want to give it a shot as a listed developers in JVs and consolidation?
Yeah, so basically, JVs are preferred, but it depends on your JV partner at the end of the day. And if you're able to raise, the capital, then I think it's the best way to, take the other one.